All right. So today, this question is from Jeevan Bhai. He asked me to talk a little bit about CoreWeave. So I'm going to share my thoughts on CoreWeave. So I have talked about CoreWeave in the past in our Discord community. In matter of fact, I think maybe about a week ago or so, I told you guys to be a little bit cautious on CoreWeave, or in matter of fact, all the data centers, because I saw a lot of institutions are getting out of CoreWeave. Even as I speak today is May 12th as I'm recording this, I still see almost 70, $80 million that are most likely going to get sold off here in next few days. So there is a lot of pressure on CoreWeave. But the story is just beautiful. So you got to hear the story out. I'm still cautious, but you got to hear the story out. So revenue has doubled year over year to roughly $2 billion. That is impressive. Contracted backlog is now sitting at $99.4 billion. I mean, what's the market cap of CoreWeave right now? Let's take a look. So market cap of CoreWeave is $58 billion. Can you imagine? What if I didn't tell you any other part of the story? What if I only told you, check out this company, the market cap of the company is $58 billion, and they have a contracted backlog of $99.4 billion. How do you think you're going to think about that company? And then I add to it and I say, you know what? This company is growing so fast that they added over $40 billion in new commitments just in one quarter. Can you imagine what are they going to do by the end of the year? Another 40 billion second quarter, another 40, like 150 billion, $200 billion of new commitments, maybe throughout the year. Now we're sitting at a contracted backlog of $300 billion by the end of the year for a company that is sitting at only $58 billion of market cap. I mean, these numbers are enormous. But markets do not only react to what happened. They react to what future might look like and what current results reveal about the cost of reaching that future. And beneath the headline growth, investors saw several things that made them uncomfortable. And that is why the stock is under stress. In matter of fact, I think a lot of these companies that has grown a lot, or at least the stock price have grown a lot, after the tailwind is over, meaning the earnings season is over, which for the most part typically is Nvidia earnings. Although lately people now also pay attention to Micron. So now it kind of gets stretched out to June. So, after that, I think things are going to cool down and you might see some of these, stocks that has gone up a lot might cool down. So we'll see how that works out. But with CoreWeave, the problem is profitability. Or more specifically, CoreWeave guided Q2 revenue to be approximately $2.5 billion to $2.66 billion. Wall Street is not happy with that. I mean, that's pretty good. I mean, for one quarter, if they're doing $2.5 billion, that's a $10 billion. And the company market cap is only $58 billion. That was enough for the market to panic. Why? Because these days, all these AI stocks are valued like to perfection. And anytime the numbers just get missed here and there, people panic and kind of walk off. Me personally, I think the story is wonderful. A lot of backlog and the revenue growth is there. I think they're going to be just fine. But the bigger problem is the margins. Margins are actually moving in the wrong direction. For comparison, Q4 2025 operating margin was around 6%. Q1 2025 operating margin was approximately 17%. So what's going on? How did the margins go from 17% to 6%? Because these numbers suggest that despite explosive revenue growth, economics of scaling AI infrastructure remains extremely demanding. Now, it's very easy to explain, by the way. Everything is going more expensive, right? The memory is more expensive, GPUs are more expensive, CPUs are more expensive, the networking cables are more expensive, steel is more expensive. So even though this sounds really crazy that their margins has gone from 17 to 6%, I just wanted to put it out there. There's a reasonable explanation for this. In other words, if all the commodities that is driving all this price hike right now, they cool down, let's say by next year, then margins will go up again. That gives me a lot of upside potential in CoreWeave. But for the time being, most people are going to ignore why the margins are down. They're going to focus on that they are down, and that is what's going to put the pressure on the stock. Free cash flow came in at approximately negative $4.7 billion for this quarter alone. This can scare anyone. What happens in your own household that when at the end of the month you look at your checking account and it's negative? And not just by a couple $100, it's negative by $4.7 billion. Of course, it's going to freak everybody out. And that is what you're seeing. Look, there is no doubt that this company is generating enormous demand while simultaneously consuming enormous amount of capital to serve that demand. And that's why, a lot of my trades right now are more focused on people who are able to take money from all of these people who are investing in CapEx. I think that is a better play for the time being. But over a longer period of time, I'm actually quite bullish on CoreWeave. The biggest problem right now that we have with all of these companies, including CoreWeave, is the debt. The balance sheet is where things start to get serious all the time. If you are thinking about buying a business, thinking about buying a franchise, before you make any kind of commitment, I strongly urge you to set up a consultation and let's go over their financials. So many times I see people buying properties, people buying businesses, people buying franchises, and they come to me after the fact. And when we review the numbers, they realize the deal was really not that good. Anyhow, in case of CoreWeave debt load now sits somewhere between, I think, $21 billion to $25 billion. That's a lot of money. Now, what happens when interest rates goes up or there's a high inflation in the country? Even today, quarterly interest expense is sitting at $500 million for CoreWeave. Management also indicated that interest cost could rise materially again next year. Not next year, next quarter. That means a meaningful portion of every revenue dollar is already being absorbed by the financing cost before shareholders see any operating leverage. This is what's creating a very fragile setup. Heavy leverage, aggressive capex, thin margins, and execution pressure. Small operational problems can quickly become financial problems. Very simply because they do not have a lot of room to play with entire numbers. The entire story depends on perfect execution. CoreWeave raised the lower end of its 2026 capex outlook to approximately $31 billion. That is enormous infrastructure built out. The company is essentially trying to construct and deploy AI data centers capacity at a pace few companies have ever attempted. That introduces execution risk, and infrastructure execution risk compounds quickly. If projects are delayed, lease cost continues, debt cost continues, depreciation continues, but revenue generation does not begin on time. That is dangerous in a highly leveraged model. For example, sometimes clients will come and say, well, Deepak, I want to invest in this syndicate that is going to build an apartment building or a commercial building. And they go like, they have some projection, they run it by me, and they go like, look, this company is saying that they're going to generate 20% return in next 6 months or a year or 2 years. And oftentimes I'll tell my clients is that, well, these projections are great, but these are not reality. Are you comfortable not making any money for next 2, 3, 4 years? And when I say that, people pause for a second and they go like, well, I'm spending $500,000. If I put that money in stock market, how much would I make? And that is exactly the point here. Investors are looking at this and going like, oh my God, if there's any kind of delay, if these numbers are priced for perfection, then what kind of opportunity cost will I have by investing in CoreWeave? So this is right now is a very highly leveraged company, which creates a risk. The reports during the recent quarter suggested a meaningful percentage of U.S. data center projects could face delays due to supply chain and power constraints. If CoreWeave experiences similar timing issues while carrying massive financial obligations, profitability could deteriorate rapidly. So these concerns are legit. And if you are an investor in CoreWeave, then you should be careful. Now, the way I like to take advantage of these opportunities is once I understand the company, which I do because this is a great business model at the end of the day, then I just simply wait for a dip. When stock is down 20, 30%, that is the time I want to get into this company. Because over a longer period of time, these issues will get resolved and the company going to be a cash printing machine. Once you move past the balance sheet stress, there are several developments that are genuinely difficult to ignore. The most important, like I said, is the backlog. You know, CoreWeave exited Q4 2025 with roughly $67 billion in contracted backlog. 1 quarter later, that number now jumped to almost $95 billion. That means the company signed more than $40 billion in additional commitment in just 90 days. That scale is almost unprecedented in AI infrastructure. But the more important detail is the nature of those contracts. So you need to understand that to see if that makes sense for you or not. These contracts are primarily long duration take or pay agreements, meaning customers are contractually obligated to pay even if they do not fully utilize the infrastructure. That is a big deal because it improves the revenue visibility of this company. The company also raised its projected annualized revenue run rate target for the end of 2026. I love that. And importantly, a substantial portion of future projected revenue is already contractually committed today. That gives the growth story more credibility than many investors realize. One of the more interesting developments this quarter involved AI inference demand. Historically, many bearish arguments around CoreWeave assumed older GPU generations would rapidly lose value as newer systems like Blackwell are scaled. The assumption was older chips would commoditize, pricing would weaken, utilization would fall, and depreciation assumption would prove too optimistic. But the quarter showed something else. Inference workloads now represent more than half of total platform activity. And inference does not necessarily requires the newest GPU architecture. Many production AI applications can still run effectively or at least efficiently on Hopper GPUs or older generation GPUs and CPUs, and that changes the economics dramatically. See, older GPUs are holding their value better than most people had expected. Instead of pricing collapsing on older GPUs, CoreWeave actually reported stronger pricing across several older product categories. This is a major development because the company depreciates its GPU over approximately 6 years. Many analysts originally believed that useful life assumption was too aggressive given the speed of AI hardware innovation. But if inference demand continues, extending the commercial usefulness of older GPUs, then the depreciation assumptions may prove conservative rather than optimistic. That changes long-term economics significantly. If GPU remains economically productive for 7 years, 8 years, or perhaps even longer, then effective capital efficiency improves materially. And that matters enormously in a business spending tens of billions of dollars on infrastructure. Now, I want to talk about customer. You may have heard me talk about this many times, that if you want to spot a good company, then you need to pay attention to how they take care of their customer, how much extra work they're willing to do for their customers, what kind of value they can deliver to their customers, and most importantly, they don't take advantage of their customer. About a year ago, a very large portion of revenue depended heavily on small number of hyperscaler customers. That concentration of CoreWeave created a serious risk. But today, the revenue mix is becoming broader and healthier. The largest customer still represents a significant share of revenue, but dependency has been reduced meaningfully. Even more important, the composite of the backlog has improved. Earlier stage AI startups now represent a smaller portion of commitments. In their place are more established enterprises with stronger balance sheets. That includes financial institutions, quantitative trading firms, industrial AI users, robotics companies, and spatial computing businesses. This matters because enterprise contracts carry far lower credit risk than speculative startups demand. Credit markets are now starting to believe in the story of AI and specifically CoreWeave. This may be one of the most underappreciated developments of this quarter. As customer quality improved, lenders became more comfortable financing the business. CoreWeave recently closed a massive delayed draw financing facility that reportedly achieved investment-grade characteristics tied to its infrastructure assets. The company has also significantly reduced its average borrowing cost over the past several years. That is a major advantage for a business planning to spend over $30 billion annually on infrastructure. The clearest signal came from debt demand itself. When CoreWeave sought financing, debt offering was reportedly massively oversubscribed. That tells you institutional credit investors increasingly view the company as more credible than they did previously. And credit investors tend to be extremely rigorous than a typical investor would be. Now, let's take a look at the valuation, because that is also important if I want to get into this business. On trailing metrics, CoreWeave looks expensive. That is understandable because current profitability remains weak. But the trailing numbers may not fully capture the economics of a business intentionally spending ahead of future contracted demand. Same thing is happening with Melly, same thing is happening with Meta, same thing is happening with Amazon. So CoreWeave is no different than them in this particular case. The more relevant question is what valuation might look like relative to future revenue generation. Using management's projected annualized run rate targets, the forward revenue multiple compresses quite a bit. Compared with several AI infrastructure peers, the valuation may not be as stretched as many investors assume. That does not make the stock cheap, so don't take me wrong. I'm not saying go jump on the stock. But it does suggest that market may already be discounting a large amount of operational risk. So, am I interested in the stock? Sure. Right now, as I speak, it's trading at 107. Around $70 or $80, now I'm really interested. So if there is a correction of maybe about 20% in the stock for some reason, I would be a buyer here. Now, there is still a lot of risk in this company. The leverage is significant. CapEx requirements are going to be there for many years. Execution pressure will remain there. And it's not a mature business just yet. It is still highly leveraged infrastructure built out, happening at extraordinary speed during the biggest AI investment cycle in decades. Things can still go wrong. And plus, we don't even really know how this business will do after everything is built out. But honestly speaking, you have to take risk in market if you want to make money. Your risk right now with CoreWeave is debt, margin, cash burn. You have execution risk. You have timing pressure on the company. But then on the other side, you have a lot of positive things as well. Massive contracted demand. I mean, that is a lot of money waiting to be collected. Customer quality is improving. Financing access is improving, especially if you get a rate cut or let's just say the government decides to help out the data centers. Inference demand is only growing. And potentially long-term unit economics. Maybe they find ways to become even more profitable. So, if you ask me at the end of the day, market obviously saw CoreWeave as a speculative AI provider. But if you dig deeper into the last ER, which I would strongly suggest that you take a look, you will notice that business is gradually evolving into something bigger and better. It's not there yet. We still are too early. This is something, if you want to get in, you have to be very cautious. You want to buy it on red days when you're able to get some good discount, and don't get too excited. You have to manage your position as well. But if you're able to hold through the volatility, maybe for next year or so, then I think this is going to represent a very good risk reward ratio. Only if you're able to acquire stocks when the market is red. So if you want to buy this, put some money aside and say, okay, this is what I'm going to use to buy CoreWeave, and you buy it slowly whenever market gives you opportunity. But as you can see, it's a great business. You just have to wait for it to mature and start producing results. We might be 2 years from there. But I'm super excited how this company is going to look like in 28. So maybe we can come back and revisit this video at that time. But if you do get into this stock, then don't go blindly. Manage your position size and pay attention on every quarter. Pay attention to the ER, see how things are working out. Because if this debt goes out of control, the stock is going to take a dive. Kind of like what we saw last year when people start getting concerned about private credit. All of these kind of stocks were tanking. So something like that can certainly happen again. So I don't want to be in a situation where I buy it high. I would rather buy it at that time. That way I have a comfortable position in this stock. So I hope that answers your question and you enjoy it. And I will see you in the next discussion call.